Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today, I was reading through the comment section. You guys want to know where to rotate after the commodity bull market. I have covered this maybe a couple times before, probably not as much as I should have. So I'm going to go over it. And what I have behind me is the market cycles for real estate. And you're saying, what does real estate have to do with commodities? It actually has everything to do with commodities. The real estate market is when you basically have a leveraging up versus a deleveraging. And we've got four phases here. We've got a recovery phase, an expansion phase, a hypersupply phase, and a recession phase. And you've got the long-term occupancy average. This is basically what keeps the market balanced, is the average. You go above the average, expansion, below the average, recovery. And then you have this big recession sell-off. You go to this guy here. Every time we have a sell-off in real estate, we have a recession. That's what these dark lines are. This is the housing starts, total units. So every time we start diving down, we get a recession. So every time the housing market basically contracts, which is deflationary, we have a recession. Right now, we're going into an expansion phase of real estate. We are leveraging up the move. Means that we're building new homes. We've got new loans going against it. The leverage and credit in the system's expanding. That's inflationary. When that reverses, when we fill the inventory levels up with real estate, that's going to reverse and come back down. And if you look at each of those dark gray lines, it means it's a recession. So almost every single time that we have a contraction in the housing starts go below the average, look for a recession. So we're going to ride this commodity bull market all the way till the end of these market conditions in real estate. Real estate, this is crazy to say, and I didn't think this was the case back in the day, but real estate and demographics, because demographics is driving this. This is a supply-demand imbalance. We have a large imbalance right now in real estate. One could say that the demographics of an area determines pricing of assets. Because as credit expands and we build all these new homes, usually it's paired with increasing interest rates. And increasing interest rates prices the assets of everything. What interest rates are doing. So if you go from a large demographic to a smaller demographic to a larger demographic, which we did from baby boomers to Gen X to millennials, interest rates contract during that period in between because it's a smaller demographic. We didn't build as many homes. And I think what's going to happen is we're going to get higher interest rates. And from the demographic of the millennials, we're going to get more homes being built. And it's going to be inflationary. So I think over the next 5 to 10 years, that's how long it's going to take to build all these homes, is going to be an inflationary period, and we should be staying in our commodity investments, precious metals and commodities. At the end of it, we should switch to bonds. It should be at a higher interest rate environment, and we're going to have a crash. And if that crash occurs, interest rates will be lowered. So we're buying it at a higher interest rate, bonds, and then selling it at a lower interest rate, which will reprice the bonds higher. So bonds is what you want to rotate into when we have a copious amount of homes in inventory and prices of real estate start to go down and housing starts start to go down towards that average. Once we eclipse the average, it's game on for recession. Everything will blow out in that type of scenario. It's a deleveraging, deflationary collapse when that happens in real estate. So we would be in bonds. We would be protected against that if the currency's still around, obviously. And after that crash, we are in a low interest rate, low inflation environment in a recovery phase of real estate. I also think that the demographics of the United States is not very favorable. So I would go and invest in stocks. Tech companies, ones that have gotten blown up, I would be in there buying The Trade Desk, maybe Roku, whatever's good in 10 years. It depends what's in cycle, but I would be looking at technology stocks and investing in technology, maybe some regular kind of like Chipotle or something like that stocks as well after that crash. So if I were to go back to the real estate cycle, this in recovery phase. I like tech stocks and stocks because it's a low inflation, low interest rate environment in this area. Right now, we're transitioning into an expansionary phase, and it's still good because interest rates haven't really gone up much. So money is still flowing into those investments. I don't know how much longer, depends on interest rates and what happens with interest rates. But this up in the expansion phase is usually dominated by energy and precious metals and materials. This is a commodity area. And then when this happens, we want to be in bonds before this thing blows out to the downside. So that is, in a nutshell, where you want to be in relationship to the housing market. I know this sounds weird, but the business cycle is driven by the real estate cycle. And that drives where you should be putting your investment money. It drives money flows into certain investments. Notice how I didn't say anything about earnings or any of this stuff. The earnings does drive stocks, but what matters more, and I've got this wrong in the past, guys, like when I was a younger investor, when I was a new investor, I didn't know this. This was really hard to tie together. There's not many people who talk about this. I haven't seen a single book on it. Maybe I should write a book, but I haven't seen it. So this drives money flows. It drives where that money goes. And where the money flows affects your investments. That's what changes the ratios. A low ratio means the money hasn't flowed into that sector. A high ratio for whatever asset it is means the money has flowed there. What changes that ratio is this. It's interest rates. And this changes interest rates. So when the interest rates start to move on up, it's going to direct money flows differently. And we're going to see that rotation occur between the assets, changing the valuations and the ratios. And we're seeing that happen right now. We're seeing it. It's happening real time right in front of our face. And I'm going to show you one chart here because it's ridiculous. It's the CRB to S&P 500. It's stocks to commodity ratio. And we put in a bottom here and we're moving on up. And it's very simple. There it is. And here's your line there. And what happens is you break this big downtrend, it comes back and does a retest. We created another big, huge pattern here, broke that to the upside, created a new, this right here is a new higher high. What that means, this right here, is that we're in a new uptrend. We came back to do a retest of this breakout here. That's what this is here. And we're going to go far higher. It's right in front of us, guys. This is it. This is it. I'm very excited. So the expansionary phase is correlating, and we're seeing in the technical analysis that the commodities are starting to outperform stocks. This rotation is starting to happen already. We're in the early innings of it. Get an investment strategy. I'm staying invested in my commodities. I'm in energy quite heavily. I think uranium, oil, natural gas, those are great investments. Precious metals are going to start to turn. We're going to see them absolutely do killer things. And when this money rotates from bonds and stocks over, it's game over, guys. It's all coming to us. Let the game come to you. Don't go chasing after it. If you guys like this analysis, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.